How can it be possible to have a market that is over $2 trillion in size, that has outperformed a number of other key global asset classes over multiple time periods over the last 10 years, yet which global investors hardly own and many know very little about? This is the surprising and pretty unique case when it comes to the domestic Indian bond market, the attributes of which we are going to discuss today. As of the end of August 2023, over the last 10 years, the iBoxx India Local Currency Index has delivered an 86% return in US dollars. That is more than EM and Asian equity markets, more than the global aggregate bond market, considerably more than emerging market debt, especially local currency, which is slightly negative, and even more than the stellar performance of China's bond market, and by large margins. Now, while past performance is not necessarily a guide to future performance, the attributes of the economy and market that have driven it certainly remain in place. But what are these attributes? First is the fact that global investors largely don't know about this market. Foreign ownership of the domestic market is less than 2%. What this means is that unlike many of these other asset classes, during crises, there isn't a significant amount of foreign money that can flow out of the market. For example, over January to March 2020, at the start of the COVID crisis, while some markets lost 20% or more, the Indian local currency bond index was only down by around 4%. It is indeed primarily a domestic market, which means correlations to other global markets is low, and the diversification benefits are exceptionally strong. Tax reforms like the goods and services tax have supported an improvement in tax revenues. The opening up of the economy is attracting significant foreign direct inflows into the country. Its service sector is booming, and the current account deficit has declined significantly. Meanwhile, the Reserve Bank of India has built an enormous war chest of forex reserves of around $600 billion, some of the highest in the world. These are used to manage the volatility of the rupee, which is close to an 18-year low of only 3.4%, much lower than G10 and emerging market FX volatility, and the lowest in Asia. Altogether, this keeps the volatility of an Indian bond strategy low, at only around 6%. Now, access to the Indian bond market has historically been somewhat restricted, which explains the unfamiliarity. Up till now, it has not been part of any major global bond indices and is thus hard to sufficiently access via other diversified strategies. However, reforms have opened up the market, and not only is it more accessible than it has ever been, but it has recently been announced that Indian bonds will begin to be included in key global bond indices from June 2024, hence the increasing focus on it. Put together, this continues to be one of the most compelling investment opportunities, one that could provide significant diversification benefits and improve the risk-return characteristics of investors' portfolios. Many thanks for watching, and see you next time.